South Korea's small-cap stocks are regaining investor interest as restrictions on leveraged ETFs tracking heavyweight chipmakers shift money toward Kosdaq names. For more on the domestic economy, we're joined today by Professor Shim Myungkyu, Associate Professor of Economics at Yonsei University. Professor Shim, thanks for coming on today.
Thank you for having me.
So the country's tech-heavy Kosdaq share index has risen more than 30% from its low now. What should investors be watching out for?
I think investors should be careful not to confuse a change in money flows with a change in fundamentals. The recent restrictions on leveraged ETFs linked to Samsung Electronics and SK Hynix have reduced one of the most speculative channels into Korea's largest chip makers. Some of the short-term investment now seems to be moving toward Kosdaq and small cap stocks. That can certainly support prices in the short run, but it does not automatically imply that the earnings outlook for those companies has improved. The first thing investors should watch is liquidity. Smaller firms usually have lower trading volumes, so prices can move much more sharply when money enters or leaves the market. Second, they should look carefully at fundamentals such as earnings, cash flow, and debt. Small cap rallies can easily become momentum driven, especially when investors are searching for alternatives after a major market correction. And finally, diversification matters. One positive effect of this shift could be that Korea's market becomes less concentrated in just Samsung Electronics and SK Hynix. But if investors simply move speculative leverage from large cap stocks into smaller firms, the underlying risk has not really disappeared.
Right, and tighter regulations on these single stock leveraged ETFs have coincided with the recent downturn in Korean stocks. So are we now seeing investors shift their focus toward overseas assets?
Yes, we are seeing a noticeable shift back toward overseas assets, particularly the U.S. equities. But I would not attribute that entirely to the new ETF regulations. In July, Korean retail investors bought about $4.6 billion in the U.S. stocks on a net basis, a sharp increase from the previous month. At the same time, we are now beginning to see money flow out of domestic equity ETFs. There are possibly two forces behind this. First, confidence in the Korean market has weakened after the recent sharp correction, particularly in Samsung Electronics and SK Hynix. Second, U.S. markets have remained relatively resilient, especially in technology and AI-related stocks, so investors naturally see them as an alternative. The new restrictions may accelerate this trend. Some investors who still want high risk, high return exposure can simply move into US-listed leveraged ETF, including products offering 3 times leverage. So regulation may reduce leverage in the Korean market without necessarily reducing investors' overall appetite for leverage. And I think that is the important point. If investors are moving overseas for diversification, that can actually be healthy. But if they are simply replacing Korean leveraged products with even more leveraged US products, then the risk is just being relocated rather than reduced.
I see. And gold prices have been relatively low for months, but they've now hit a 2-month high as markets await U.S. inflation data this week. What's driving this, and where do you see gold prices heading from here?
I think there are 2 major forces driving gold prices right now. The first is safe haven demand. Geographical uncertainty remains very high, particularly because of the renewed tensions between the US and Iran, and uncertainty surrounding the Strait of Hormuz. When investors become nervous about geographical or financial risk, gold naturally becomes more attractive as a safe asset. The second factor is US monetary policy. Gold does not pay interest, so when interest rate rises, holding gold becomes relatively less attractive. That is why this week's US inflation data will be so important. If inflation comes in stronger than expected, markets may expect the Federal Reserve to raise the rates again, which can possibly put downward pressure on gold. But softer inflation than expected would reduce that pressure and could support another move higher. So looking further ahead, I think long-term environment remains relatively supportive for gold. Geographic uncertainty is unlikely to disappear very quickly, and demand for gold as a portfolio hedge remains strong.
Right, and more broadly, the United States has stepped in to buy Japanese yen for the first time in more than a decade. This is a rare bilateral intervention in Japan's currency market. What's behind this, and what impact could this have on South Korea's currency and the global currency market?
There seem to be two important reasons behind this unusual intervention, as you just mentioned. First, the yen had weakened to an extreme level, creating concerns not only for Japan, but also for broader financial markets. A very weak yen increases import prices and inflation in Japan, while also encouraging large speculative positions based on the assumption that Japanese interest rate will remain low. Second, U.S. participation sends a much stronger signal than intervention by Japan alone. It tells markets that both governments are uncomfortable with excessive currency movements and are willing to act together. But intervention alone probably cannot permanently strengthen the yen. The fundamental issue is that the US-Japan interest rate gap still remains very high at 2.5 percentage points. As long as that gap remains large, there will continue to be underlying pressure on the yen. And for South Korea, I think stronger yen could actually provide some support for Korean won. The yen and the won often respond to similar regional and global forces, and an extremely weak yen can put competitive pressure on Korean exporters and also weigh on another Asian currencies. So if the intervention succeeds in stabilizing the yen, and especially if the Bank of Japan follows with a rate hike, it could reduce some of the depreciation pressure on the Korean won as well. But eventually, the won will still depend much more on Korea's own fundamentals, U.S. interest rate, and global investor sentiment.
I see. All right, Professor Shim, thank you so much for your time and insight today. We appreciate it.
Thank you.